Hello and welcome to another TLC Tutoring Company accounting lesson. Here we're going to be going over the equity method of journalizing stock investments. If you are looking for the cost or fair value method, please do me a favor, go to the description below. I'll have a link to that video in the description for you. In this case, we're using the equity method, which means that this company is able to have a significant influence on the company that they are investing in. Keep in mind, when a company invests in stock, they are essentially buying ownership of that other company. So academic textbooks tend to say that significant influence over another company is typically in the 20 to 50% range, which means that that investing company would have to own 20 to 50% of the other company's outstanding common stock. So in this case, we have Diamond Company, or Diamond Inc., purchasing 50,000 shares of Holden Company for $350,000. Now notice that it says here that Holden Company currently has 200,000 shares of common stock outstanding. So here, 50,000 out of 200,000 shares, it appears that they might be able to have that significant influence over Holden Company. And we also see that it's 25% of the company that they own. So in my opinion, that would probably be considered significant. So since they own 25%, we are going to use the equity method. So let's take a look at that first one. On January 12th, we are purchasing an investment in Holden Company stock, and we are paying $350,000. And our credit will be to cash, showing that our cash is going down. Remember, debit to the investment, debit to investment in Holden Company stock, since it is an asset, debit to make it go up, credit to cash to make cash go down. Now, one very important part of the equity method is this word in. You'll notice when we went over the cost method that we used investment dash. That dash indicated that we were using the cost method. Here, by saying in, we are creating a special account here just for Holden Company stock, and that is what we do when we use the equity method. So investment in is going to be very important when you're journalizing these entries. All right, so that's it for the first one. Let's take a look at our letter B below. On March 31st, Holden Company reports net income of $50,000, and Holden Company also pays a $20,000 dividend. Now here, the equity method is really interesting because since we assume that they could issue significant influence over this company, any net income that Holden Company reports, we get to report a portion of that as income as well. It's a very interesting concept, this equity method. So whenever Holden Company reports net income, we record a portion of that as an increase to our investment and income. So let's go ahead and record that first entry. For now, let's ignore the dividend. So on March 31st, our investment in Holden Company stock is going to go up, and our credit income of Holden Company, it gets its own special account, is also going to be going up. Now the amount that we are going to use is going to depend on how much of that company we own. So in this case above, you'll notice that we purchased 50,000 of the 200,000 outstanding shares. So we actually own 25% of Holden Company. So when Holden Company reports 50,000 of net income, we get to record 25% of that. So we're going to get to record $12,500 as an increase to our investment and as income for our company. So that's what makes the equity method so interesting. We have this scenario where we own 25% of the company, and because we own such a large percentage, whenever they record net income, we get to record a little bit of income. It's definitely it's interesting, definitely. Now the second part is I'm also telling you that Holden Company paid a $20,000 dividend on March 31st as well. So we are going to have to record that dividend also. So our debit is going to be to that cash account. And now our credit is another interesting part of the equity method. Since we recorded that our investment in holding company went up whenever they declared net income or whenever they reported their net income, that investment account is actually going to go down whenever they actually pay us a dividend. And a big way of thinking about this is, and usually the way that we try to explain it to introductory accounting students, is whenever a company has net income, typically that net income, if they really wanted to, they could declare a dividend and they could go ahead and give some of that net income to their shareholders. We have such significant influence in this company that we could probably sway the vote about whether or not to declare a dividend. So we say that that's our income. If we wanted that money, we could get it. So we increase our investment and we record that income. Now that we're actually getting that dividend, then we have to decrease our investment. So it's kind of sounds a little bit like retained earnings. It goes up by net income, down by any dividends. So if we increased our investment whenever we recorded that net income of holding company, we have to make it go down whenever they actually give us some of that income through a dividend. All right, let's talk about the amount here as well. It says that they paid a $20,000 dividend. Keep in mind that that is a total. We only get 25% of that because we only own 25% of the shares. So we're actually getting a $5,000 dividend. All right, now on to this last one. On April 24th, Diamond Company sold their investment in holding company for $360,000. So we, Diamond Company, we're getting rid of that investment. So let's start with the easy part, cash. Cash is going to be debited by $360,000 to make that asset account go up. Next, I'm going to go ahead and credit investments in holding company stock. You'll notice I left a line here. You'll see why later. Now, a lot of us are tempted to just go ahead and debit it for that $350,000 that we first paid for it. But keep in mind, during the life of this investment, it went up and it went down. So we have to find the current balance in that investment account. So let's go ahead. I'm going to make a T account off to the side, and that way we'll be able to find the current balance. All right, I have a T account set up. Let's find the balance in this account. So we originally debited that investment account for $350,000. So let's put that on the debit side. $350,000 debit. If we look at entry B, we'll see that we also have a debit to investment for $12,500. Let's debit that investment for $12,500. And then we see that in B, we also had a credit to the investment account by $5,000. So remember, if it's on the same side, we add. If it's on opposite sides, we subtract. So in our case, we have $350,000. We added $12,500 to it, and then we credit it for $5,000, taking away. So our current balance is $357,500 debit. So let's get rid of that since we're selling it by crediting it. All right, so now when we take a look at these two accounts, we see that they are not balancing. This journal entry, as we know, must have our debits equaling our credits. So let's see what we would have to plug into that short credit side in order for it to equal that $360,000. So $360,000 minus $357,500. $2,500 is that missing amount. That's our plug. And our plug account for this is going to be either a gain or a loss. Now, just like with any other gain or loss plug, if it is a debit plug, it is a loss. If it's a credit plug, it is a gain. So in this case, we have a credit plug. So we have a gain on sale of stock for $2,500 credit. And that's all there is to journalizing stock investments using the equity method. If you have any questions, please feel free to leave a question in the comment section below. And I'm going to go ahead and make an additional video for you guys today for bonds. But in the meantime, thank you so much for watching and happy studying.